the evaluation of assets and liabilities, although we'll focus more on the assets, and this is normally guided by International Accounting Standard number 2. Now, by the end of this learning, you'll be able to expect you're supposed to be able to explain the measurements and evaluation principles of inventories. You're supposed to distinguish between raw materials, work in progress, and finished goods. You're supposed to be able to apply the cost formula in valuing inventories. You're supposed to be able to prepare and interpret journal entry related to inventory valuation and recognition in financial statements. So some key definitions. So inventories. So these are the assets held for sale in the ordinary course of business, in the process of production for such sale, or in the form of material or supplies to be consumed in the production process or in the rendering of services. For example, if you look at the milling companies, the Joy Miller or any other, they have the various inventories. For example, maize is a raw material, but it's an inventory. Then we have the finished product, that is the packed uga. Again, that's a finished product. So we are going to look at the various types of inventory, but that's just a simple example. Then we have the cost of inventory. And the cost of the inventory refers to all the cost of purchase, cost of conversion, and other costs incurred in bringing the inventory to the present location and condition. Again, when you talk about the same setup with the manufacturing of uga, so we have the cost of the maize, that is the raw materials, and then converting those maize into uga and packing them, and even taking them to the location that they are supposed to be in. Then we have the net realizable value, and this is the estimated selling price in the ordinary course of business, less estimated cost of completion, and the estimated cost necessary to make the sale. So net realizable value, which is what is going to be realized when you remove the cost and even the logistic cost. Yeah, for example, when you talk about the same uga again, we have the selling price of the uga, but you need to remove all the costs that are associated to make that packet of uga the way it is. Then we have the cost formulas. As per IS number 2, there are two formulas which are recognized, which is first in, first out, and then we have the weighted average cost. Of course, there are other methods for valuation of assets, like we have the LIFO, last in, last out, and others. But the one which are recognized, or the one that are recommended by the International Financial Reporting Standards, these two. Then we have the write down. So this write down, this is the reduction in the carrying amount of inventory to the NRV when the cost exceeds the NRV. So we can have a situation when the cost is more than the selling price, and when this happens, we normally say we write down, and we look at the impairment of assets, where we saw that the asset cost exceeds the selling price. Although we looked at the various method of valuation of the impairment, but in this case, it's as simple as the cost. When the cost has exceeded the selling price, you need to write off the difference. We are going to see how to write off the difference in an example. Then we have the raw materials. So I said that we look at the various components of raw materials. So in the first one, we have all the various components of inventories. So we have the raw materials, and these are items purchased for use in production or manufacturing of finished goods. An example, we have timber, steel, flour, and fabric. Those are the raw materials. Although I don't think this flour will fit here. It should be made. should be maize. Although flour can also be used. If, for example, you are manufacturing or you are in a bakery industry, flour can also be used there. Then we have work in progress. We have work in progress and work in, these are partially completed goods still undergoing manufacturing or assembly. Example, you have half-finished furniture or unfinished garments. So the way you have the garments for, or unfinished furniture, which are still getting polished so that they can be used for various use. Then we have the and these are completed products ready for sale to customers. Example, we have the packed blade, assembled electronic, etc. Then we have the accounting for inventory. So how do we account for inventory? So now, as per the International Accounting Standard, we normally talk about something called initial recognition. How do we recognize the asset initially? Or how do we recognize inventory initially? So the inventory are recognized at cost when produced or when purchased or produced. That is to say, if, for example, let's say you're in a business of selling mobile phone. So you buy a mobile phone at 10,000. So you're going to record that mobile phone in your books as 10,000. That is what we call the initial recognition. And this 10,000 should include the cost of even bringing the mobile phone in your shop. Maybe there's some logistic cost, there's some import duties, all those costs that you include. The purchase price, which is 10,000, then you add all the other costs associated to bringing that inventory into your shop. So that's how you are going to record that asset. So, but we can also say inventory cost is equal to the cost of purchase. That is the initial cost. If, for example, it's a manufacturing concern, the initial cost of the inventory, then the cost of conversion, that is, you are now converting maize into flour, and then any other cost. For example, we may expect in a manufacturing company, we have costs like the fuel cost, that's the diesel or petrol. We have the machine learning cost, we have the electricity cost. All those costs, you include them so that you can get the cost of the inventory. So we have the cost of the inventory cost. We have talked about the cost of purchase, that is the initial purchase of the inventory. Then we have the conversion cost. So you add the labor. Remember, in the cost accounting, we talk about the direct labor cost. We also talk about the indirect labor cost. Then any other cost that is incurred in the production. Now, that first part is on the initial recognition. How do you recognize the asset initially? We have said this is the cost, and the cost include everything that is associated to make that particular product a complete product. If it is a packet of Uga, the cost is all the cost associated to make that packet of Uga. Then we have measurement after recognition. So there are some activities that normally take place after you have recognized the asset. For example, when you look at the impairment of the asset, we looked at what can make an asset being impaired or what can make an asset decline in its value. If, for example, it's a mobile phone, yeah, these days, mobile phone, they keep on changing the model. So you find that there are people who always like, the new version of the model, the new version of the mobile phone. So that means the older one, its value goes down. If, for example, you're talking about perishable goods, yeah, you brought some cabbages from, or maybe Mela from Embu to Nairobi, yeah, but for some reasons there are some challenges on the load, and you find that the Mela they are arriving at Nairobi not fresh. If they are fresh, the cost is different. And if now they have taken some time on the load, the cost is different. Or we have some medicine which are nearing expiry. For example, if you go to the supermarket, you find crazy offers. Please always be careful. Check on the expiry date of those crazy offers. You might, for example, go and find that a packet of Uga is going at, it's about to go at 170, but it's now being sold at 150. And it happened that you buy 5 or 10. Please check on the expiry date, because those offers in most cases, they are normally called forced offers. Forced offers meaning the expiry of those products is very near. So after recognition, inventory are measured at the lower of cost and net realizable value. Then remember, we have said the cost. What is cost? The cost is anything that is associated in bringing the asset into completion, be it the initial purchase price, be it the direct cost, be it those taxes, all those are the cost. Then we have net realizable value, NRV. This NRV, we have said this is the selling price minus the cost that are necessary to bring that asset into sale. Any cost that you use to ensure that you sell that particular product, that's what we call the net realizable value. So you measure these two and you take the lower of the two. So we are going to look at a practical example, and this one will bring that concept home. Write downs. This we have said if the cost of the inventory exceeds its net realizable value, the inventory must be written down to its NRV. So the write down may occur due to, so these write downs, if the cost of the inventory is more than the amount that you can sell, yeah, the cost is more. So the cost, let's say it is 30 shillings, but what you can realize when you sell the inventory is 20 shillings. So you see there is a difference of 10. So that 10 is what you are calling the write down, or we are going to expense that because the cost is more than what you can realize when you sell the asset. So some of the causes of the write down or the cost exceeding net realizable value include: one, physical deterioration, for example, perishable good like food item or pharmaceuticals nearing expiry. So this is what I was just trying to say, that you may find that in some instances you are selling a good at a loss, yeah, because those goods, yeah, nearing expiry. Or for example, when you go to a market and in the morning a cabbage was costing 10 shillings, in the evening it is costing 5 shillings. It's because of the asset is deteriorating, the cabbage is deteriorating in its value. Another cause is obsolescence. For example, the old models of phone or computer after a new version launch, price decline, a drop in electronic price after a new model is released. Any write down and reversal are recognized with the profit or loss. So if you do any write down, you normally pass an adjustment. So one goes to the P&L, that is the expense. One is the expense, and the other one is the inventory. So you are going to reduce the inventory by the write down. Now we have an example here. ABC Limited holds 1,000 units of inventory purchased at $15 per unit. The selling price has dropped to $14 per unit, and the estimated cost to complete the sale, including transport and marketing, is $1 per unit. According to IS number 2, at what value should ABC Limited report the inventory? So we have said that the inventory is reported at the lower of cost and net realizable value. So the first step is for us to compute the NRV. So NRV is equal to selling price minus cost to complete the sale. So we have said the cost to complete the sale. These are the costs that are incurred. For example, the transport cost from the warehouse to the customer. So the selling price is 14 shillings. Then we have the cost of the transport is $1, and that means the NRV is $13. Then compare, the second step is for you to compare the cost and NRV. Cost per unit is 15 shillings. Yeah. Then the amount that you are going to realize when you sell is 13. So, and therefore, we have said you record the asset at the lower of NRV and cost. So since NRV is less than the cost, the inventory must be written down to NRV. So we say that the difference between the two, the difference between the cost and the amount that you realize, is a write down. So we are going to write down the difference. So step 3 for it is to compute the total inventory value. So the inventory value will be 1,000. That is the unit that you are selling times the price, which is 13. The NRV is 13. It is the ROAF, which is 13,000. So your asset or your inventory will be valued at 13,000. That is to say, the cost, of course, you have gone a loss because you used $15 to have the inventory. Let's say you have purchased a phone at $15, and then you are selling it at 13. So you are getting into a loss. So the cost is more than the amount that you can realize when you sell the asset. And that is how we arrive at the write down. So the difference between the two, so these are the units, these are the price, but you need to multiply by the units so that you can get the total inventory value. So that means ABC Limited should report inventory at 13,000 and the IS2. So then the write down will be the difference, $15 minus $13 times 1,000, which is $2,000. Debit inventory write down, that is the expense, $2,000, and credit the inventory, $2,000. So I want to pause there and ask us if we have any question or clarification so far, before we go to the last segment. And do you have a question there or a clarification that you want to seek for?
No.
Wajiko, you have any clarification?
No.
Meli, do you have anything? Okay, fine. So let us move to the next one. So we look at the cost formulas. So this cost formula, so I have talked about the first in, first out, and I'm very sure this is something that you have handled at maybe the cost accounting. So I'm not really doing so much on this one. But the first in, first out, this is where we value the oldest inventory first. So the oldest inventory are recognized first. Then we have the weighted average, where we weight the average cost, which is equal to the total cost, you divide by the total unit. Again, we are going to look at this practically. So we have an example of first in, first out. So you are given this information. Hope this information is, you can be able to see it clearly. So we have this information. So you are required to calculate the value of material issued on May 10 and 25 using first in, first out to determine the value of closing inventory as at May 31st. So if you are given this kind of a question, so we have said that we are using first in, first out. First in, first out. So the goods which arrived first are the which are going to be sold first. So let us look at this one. So we have these dates here. So on May 1, we have an opening balance of this. That, according to first in, first out, so these are the ones that you are going to sell first. Once you exhaust this one, and you're going to sell them at a cost of 10 shillings. Once you exhaust that one, you go to this one, and then you sell this one at a cost of 12. So here we have a case where we sold or we issued this. We issued inventory, we issued 150 inventory. So how are we going to value this? Can someone open the mic and tell me what will be the value of this from just simple illustration?
The first 100 at 10 shillings, then the rest 150 at 12 shillings.
Come again?
The first 100
Mm-hmm.
at 10 shillings, Then the
Nice.
rest are the 50 at 12 shillings.
Or 50 light. Yeah, the deficit will be 50. Is that true? So because it's a 100 minus 1, so the first, yeah. So you are going to issue the first 100, you issue at 10 shillings, but we want 150. So there will be a balance of 50. So 50, you are going to remove them from here. That means that is 50 multiplied by 12. Yeah. So thank you for that. So now let us now issue the other one. So here we remain with what? We remain on 150, which are not being issued, right? We remain with that one there. So then when you come here, the purchase, we have this one, then we have issued this. We have issued this. So can someone now tell me how we are going to issue this one? So the first one, we have talked about, let me just put it here. We have talked about 100, you multiply by 10. That's the first issue. Then plus 50, you multiply by 12, that's the second issue. Plus, so now the third issue will be what? How are you going to issue the 180? Maybe tell us, how are you going to issue that? How are you going to issue 180? Maybe tell us how are you going to issue that one? And do you have something on how you are going to issue that one?
The first 150 we issue at 12.
150.
And then the rest 30.
Yeah,
30 at 14.
30 at 14, yes. Yeah, so that's how we are going to issue that. And then you just get the answer. So what will be the value of the what will be the value of the inventory remaining? So we have answered the first question. This is the first one here. We have answered that one correctly. What will be the second one? What did you remain with? What have you not issued here? Wajiko, what have you not issued here? Or what's the balance of what we have not issued? It's Wajiko with us. It's always good to say something. If you feel lost, please indicate that you are lost so that at least we can still do it again, but don't not just keep quiet. Wajiko, we are waiting for you. What is the value? What are the inventory that remain after you have issued all this?
100.
No. Is it? No, it's not
70
100.
units.
How much?
70.
Yes, 70. So 70, what will be the value of this 70? You multiply by 14. Yeah, 70. The 70 are from here. Remember, this is what we have issued. We have issued 100, we have issued 50, we have issued 150, we have issued 30. So we just removed 30 from this one here. So what is remaining is 70. So 70 multiplied by 14. So and that is how you're supposed to work on that one. Yeah. So from this one, it's the same discussion that we have just discussed how you need to work on that one. So now the last one is the weighted average. So for the weighted average, what you need to do, you need to get the total. The formula for weighted average is that you need to get the total cost. You divide by the the total units, the total cost you divide by the total units. So first of all, you get the units. So these are the units here. The units are this one, add this one, sorry, add this one, add this one. Those are the total units. So once you add this, then get the cost. Yeah, so the cost will be this times this, this times this, this times this. So divide total cost, you divide by the units. So let's see here. The first one is get the total units in the inventory before sale. 532, get 1,000 units. The second one, calculate the total cost of the inventory, get the inventory cost is 500. 500 you multiply by its cost. Where is it? 500 multiplied by 8, 300 multiplied by 9, 200 multiplied by 10. Okay, you'll get this. Then the weighted average will be total cost, which is 8.7 divided by 1,000, which is $8.7. So then the cost of the issue, we have issued 600 here. You multiply 600, this 600 here, yeah, multiply that 600 by the weighted average cost, and you get these dollars here. Then the closing stock will what remain. So we had 1,000 here minus the 600. So we are remaining with 400 units. So the value of the closing inventory will be 400. You multiply by $80.7 and you get $34.80. That is the value of the closing inventory. So now that marks the end of that particular segment. And then you have this assignment. Please look into that assignment and you work on it maybe before our next class. Okay, so